Spring cleaning is still with us. In meteorological terms, we have still spring cleaning that goes on for a few more weeks. In terms of the cosmos, then it starts on the 20th of this month. But folks, we talked about spring cleaning in terms of getting your house in order. We talked about in general terms. We had a fantastic session last week when we talked about innovation with Joe. This week's, it's the world of finance and spring cleaning, your financial everything. So in a few moments, we're going to come back after this very heartwarming and muscle pumping, blood thumping music. What fantastic! I love that music. It's a great way, I think, to kickstart the show and get us in the vibe. Don't you think?
It is. I love it too. And we, as I say, every show we do actually bop, and maybe we ought to flip backstage and show that sometimes. But
if we want to maintain an audience base, perhaps we shouldn't.
Yeah, we're like mum and dad dancing, aren't we? Doing that. So, but it's good fun. And today, all about financial spring cleaning, because we're in spring, and we've got the amazing Mahmood, best business partner on the planet here. And we're going to really get a good insight on money, finances, what we can do. You know, April's coming. For some, that's at the start of the new tax year. For some, it's at the start of a new financial year. So now's a really good time to think about where you're at, where you want to be, and what to do in between. So great that you can join us. Let us know if you're watching live. Tell us where you're watching from. We'd really like to know that. If you've got any questions for us to answer, tell us that as well. And also comment if you're watching on replay, because we reply to everyone who comments. It's good to see you, good to have you with us. And good to have your knowledge here as well, Mahmood, because anything money related is really in your space. But so many people find it hard to talk about money, deal with money, face money. Why do you think that is?
That's a fantastic question. I think there's many and varied here, Joe. I think you've got to look in terms of people's backgrounds, you know, the lives that they lead. You've got to look at their families. You've got to look at their cultural. You've got to look at their sort of how they're growing up. So certainly in some families, and I think people's behaviour, how they react with money, is as much about the temperament they develop. So for some families, money wasn't really talked about. It's considered quite a vulgar subject. Don't really discuss it. There could be a lack of financial education. You might have come from a background where money was quite abundant, or money was quite, in very limited short supply. I think also there's certain sections in the UK and I think around the world where actually talking about money is considered to be quite vulgar. It's quite tacky. You know, it's not really the done thing here. And I think also it puts people in a very embarrassing situation as well. So I think there's lots of complex reasons, religious, cultural, family backgrounds here, and they all feed into that mix in terms of why people find it very difficult to discuss and handle money.
And it's interesting, isn't it? Because from a small business point of view, particularly, I was reading research, and also there's some stuff on the Small Business Commissioner's website around this, that cash flow and worrying about money is like the biggest stressor for small business owners, and particularly things like late payments and unexpected events and so on. So it's a real thing, and it doesn't just affect how we do in business, but it affects well-being as well, and it affects relationships as well. So, if somebody's listening right now and they're thinking, I know I've got so many challenges, but where do I start? How do I sort this out? Particularly where they might be a bit scared of getting into it. What would you advise them to do?
I think it starts with a few things, and I think that's a great point you made there. And there is definitely, there's evidence, the studies that back it up. There is a correlation between your own well-being and how you handle money in your business, and how you handle money in your business and the impact on your own well-being as well. So there's a bit of a circular thing here. I think there's a few things I would probably recommend. Number one is to probably re-engineer your brain and to think about the importance of money. So we're not talking about what you do with the money that you earn. We're talking about the very fact that money is a central plank of the business, and it represents and it translates from what you're doing. So, for example, money is there for a primary purpose to deliver your why. So whatever your reasoning is for going into business, money is the fuel that makes it happen. Money is the thing that sustains it. Money that gives you the prosperity for your workers, your team, and for yourself. And money allows you to be sustainable and let you carry on delivering your why to your audience. So I think the first thing is to look at that relationship with money and try and actually be more positive with it. I think secondly, finance, I think, is one of those functions, weirdly, I wouldn't call it hijacked, but it tends to be siloed off to technical finance people that take possession of that and don't necessarily share that well with the business owners there as well. So I think you've got to definitely disconnect between the business owner, who may not be a finance person, and the finance professionals who, in general terms, no disrespect to any finance professionals out there, tend to work very silo thing here, and they tend not to share that information in a good, accessible way as well. So for me, it's not the systems necessarily. I think you really got to try and work on those mindset muscles.
Yeah. So for spring cleaning, then we'll go through a few scenarios if that's all right. And I know
absolutely.
Yeah. So the first scenario is for someone who wants to spring clean financially, both business wise, so that the business performs better, but also they're in a better place for themselves, perhaps with their own personal finance as well. But if you're spring cleaning a business and the finances haven't been great, maybe taken a bit of a knock through COVID, a bit behind on the business plan and so on, and you really want to pick that up and drive the business forward again, what are some of the steps that a person in that situation can take to bridge that gap and move from one place to another?
I think probably the first thing I would probably focus on, if there's one document, device, thing that I would recommend all business owners to do, whatever their size, wherever they are in their business cycle, is to do a financial story, a financial plan that says, and there's a connection here. If you think about where you want to take your business and where you think your business is going to go, that sort of northern star with me and you've often talked about, what does that look like when you translate that into financial impact? So what's the, based on your journey you're going to take first, the coherent story, get a financial plan put together. What does that look like financially? And then I think you can then work backwards to plug in the gap. So typically, if you've got ultimately a financial plan that's delivered, and there's lots of things that go into making it, you're then going to think, okay, there's a document, there's a financial plan for the next year, the next 2 years, the next 3 years. Okay, to make it workable, I need to then think, I've got to think about how do I actually capture that information with minimal impact on resources? How do I capture that information effectively? So that means systems cleanup that you've got to do. Secondly, what do I need to look at to actually make it accountable? So it's like an accountability document I've got to check in. So therefore, what's your milestones that you're going to measure against? And that's probably what I would do. Plan first of all, because the weird thing is, Joe, and a lot of people think in terms of let's do a cash flow. They see it as a very a regimented document here, and it's not. It has a massive impact on people's well-being. It means that when you're thinking, oh, I can't afford to do this and I can't afford to do that, and what happens if I want to take time off? Those questions are answered when you put together a financial route map and a financial plan. So that would be my first start. Whoever you are, whatever size you are, put together a financial route map.
And how long does it take to do something like that? Do you have to clear a week out of your diary? Does it go over weeks, or are there some short burst activity things that can be done to accelerate it?
Well, that's great. I mean, I would say that if I base it on sort of recent experiences here, if you're doing it as a DIY exercise, you can, and if you haven't got that degree of expertise, it could take you as long as it takes. You could take a few days a week. I have seen it done. I have dealt with clients before, and we've managed to turn around something. When I say over a 3-week period, that's step one, to think about some key variables at the beginning. Go away, think about it, reflect on it, come back, challenge the numbers. So typically you can do that in probably 3 short bursts. You can do it in a week, you can do it in much less, but I would probably space it out in a 3-week period here. Thoughts, dump it down. We've talked about memory dumps before, and for me, it's like a memory dump, brain dump of getting things out there. Look at the story, challenge it, and I think you can typically get one delivered within, say, a 3-week period. And that's being comfortable with yourself.
And at the other end of the spectrum, there might be businesses that are, trading really well and have been for some
Yeah.
time and sitting on a pile of cash. Can a business ever have too much cash?
Yeah, I think you can. I mean, cash is basically an asset. It's a resource that you're going to be using in your business. So, rule of thumb, lots of business owners I meet, they because they're very cautious, they're scared, they're anxious. Okay, they build up surpluses of cash, but if the cash isn't working for you in your business, it's redundant. So, I would say rule of thumb, I would probably set myself a target saying, if you've got money in the bank that can support you for 3 months, if nobody came into your business, nobody bought from you, nobody wanted to buy anything from you, could you survive for the next 3 months? And that's how much cash you should be looking at. Beyond that, if there's any surplus cash, either use it for something which takes your business forward, or use it to reward yourself. Get it out of the company and use it for your own personal lifestyle. So I would say, yes, you can. Typically 3 months for me would be as a rule of thumb that you're looking for. Anything over that, you could argue is excessive.
What do you see some people doing that actually could save, if they didn't do it, or if they did it differently, would save them significant tax? So I'm talking about being legal and above board, and
For sure.
everybody should pay an appropriate amount of the tax that they owe and are due, and all of those things. So I'm not talking about doing anything dodgy, but what are the things that you think actually there's a tax inefficiency there, and some top tips for people looking at the finances at the moment?
I think there's a couple of things that I would throw into that, Joe. So in terms of the more obvious things that, what people can do, this is something that's going to benefit them as owners, benefit their businesses. Things, for example, like financial products like pensions. So pensions is a long-term gain in terms of financial. When you start to slow down things, it's a good way to extract money out of your business, because you can potentially cash 25% of that pot in when you get to 55, 57. It saves company tax and it benefits you personally. So that's immediate things. There are other things you can do. And here's where I would be careful. I think we can be in a danger in this country of letting the tax dictate a decision when actually it's the wrong way around. So if we look at rates of tax currently at the moment before it goes up, roughly about 19% here. If something is going to advance your business, that's the key thing. If there's a commercial rationale, then things like investing in infrastructure, investing in equipment are going to be really beneficial. Things like that save water, technology, energy efficiency, electric vehicles, great in terms of investing in those assets. That's good for the business. But if you're going to invest money just to save tax, so the way I would look at it is to say you could spend £100, it saves you effectively, let's say 20 quid for argument's sake, but that's £80 could be a redundant spend. I'd rather pay tax and actually have that extra value being created. Other things, look at employing people. So there might be that situation actually that says employing a member of staff is actually more productive for you, effective than having freelancers. So if you've got a lot of demand on a freelancer's time, you might think actually, even though there's some additional management issues about employing somebody, employing staff might be a good thing to do as well.
Yeah. So what about things like VAT then? Because I think the threshold for VAT is as soon as you hit, it's around about 85 grand, something like that.
That's correct, yeah.
Yeah, you need to start paying VAT. So I know some businesses are afraid of hitting that turnover mark because they think they're going to have to start all the VAT paperwork and everything else. But so question about that, and also, what about businesses that are perhaps below the VAT threshold? Can they register, and is it beneficial for some of them to do that as they're thinking about finances? Yeah.
I'd look at it in two ways. First of all, let's say you hit that VAT threshold and you've got a type of business that has to register. Once you go over 85 compulsorily, just remember you become a tax collector. So you sell services and goods, you add VAT if it's appropriate, you collect it from your customers, you buy goods and services from your suppliers, you pay them VAT, you put it into a bucket. If you're collecting more than you paid out, you give it over to HMRC. And as long as you get that psychology that says VAT doesn't belong to me, I'm acting as an unpaid tax collector for HMRC. I don't get rewarded for it. I don't get holidays. I don't get bonuses. But if I get it wrong, I get a slap on the wrist. All that money, just take it out of your main current account, put it to one side. And that's a collection. Now, does it make a difference? If you're selling what's called B2C, then it makes an impact because automatically, business to consumer.
Yeah.
So if your end client is you're a retailer, your end client is an individual, or they're a business that's not registered themselves for VAT, then when you put up VAT to say 20% top line figure, then you become more expensive in their eyes. So that's a challenge. Yeah. And typically what you would normally do there, you either transition up there, or you might say there might be other ways that I can actually minimize that burden. Now, you can also do it voluntarily. And there are situations I recommend people to do it voluntarily. When I started 28 years ago, I did it voluntarily. And what that means, if you're selling B2B, business to business, and those other businesses are VAT registered, it's irrelevant to them whether you're VAT registered or not. So that's one thing. Secondly, there's still, I think, a psychological signal that says if I'm VAT registered, I'm a bigger business than I actually am. And therefore, it may convince some customers, because clients don't want to work with you if you're quite small, because they think you might not be here next year, you might not be here the year after, and I need somebody sustainable in my supply chain. So therefore, I might get a stronger impression of you. It doesn't matter if it's correct or not. That's the impression we get. So yeah, I would do it voluntarily if you're selling business to business. I wouldn't do it if you're selling business to consumer.
Yeah, and of course you can claim, if you've registered, you can claim the VAT back if you buy a laptop or something for the business, genuinely for the business, you can claim the VAT back as well. So there's some offsetting there as well. Really interesting. Thank you. We've got comments here from Joanne says hello.
Hi, Joanne. Good evening.
Yes. So thank you for watching, Joanne. That's great. See if I can get that. There we go. So VAT, and then the whole thing I think around what's the big mystery is what should you do about your car? I know a lot of people are thinking about electric vehicles and cars and all of that as part of the spring cleaning, and there's so many great options available now. What would you be doing?
I think that's that classic depends. So let's assume, first of all, your business is structured as what they call a limited company. So you're called Joe Limited, for example. Now, first of all, in legal terms, that's a separate beast from you as the individual. So first of all, key thing is the vehicle that you're buying, if it's provided through your company as a company car benefit, that means you don't have to fund it out of your own pocket, out of your own savings. If it's electric, that's fantastic. It's probably one of the best benefits you'll get, because the amount of tax that you'll pay on that will be quite negligible. The company can claim the whole cost. You can pay for all the repairs and maintenance and everything else, and it's win-win for the company reduction and for you personally. If it's anything outside of that, like a petrol car or a diesel-powered car or high CO2 emissions, in general terms, it's not normally recommended to buy through the company. However, it can still be an advantage. So electric cars are great value. If your partner can put up with it, by the way, buying a van to use as your commuting vehicle can also be a very beneficial thing as well. Whether you want to actually go out and be seen in public in a van, which is fine, it may be a different point of conversation.
No, it's very practical. There's all sorts of things you can get in.
100%.
So nothing, yeah. So vans can be good for sure. So okay. So from a financial spring cleaning point of view, then so far we've talked about what to do if you are behind where you want to be financially, and how you can get in front again and create a plan and a cash flow to do that. We've talked about what if you've got a lot of cash in the business, what might you want to do with that cash, and some ideas around that, and also some tax efficiencies too. So we're covering quite a lot of ground here. This is fantastic. We've talked about VAT and VAT registration. One thing that we're asked a lot, so we'll raise it here, I know you're asked this a lot as well because we've been in the same sessions together, is businesses that want to scale and grow and get to the next level, but they need that capital injection. They need that finance to get the equipment, the property, more people, before they're going to get the revenue coming in from that growth. They need to invest first. Sure. So from a financial spring cleaning perspective, what can people listening do to bridge that gap, get ready for it, and then go after the right sort of funding and investment? Okay,
I think it all comes back. I think the source document, first of all, is your financial plan. So once you've identified what you need, identify that you actually need the asset, identify that you actually need that investment, whether it's new equipment, new plant, new machinery, intellectual property you've got to acquire. So once you've identified there's a commercial need for it, then you can look at the different ways that you can fund that. And you've got everything from conventional borrowing of money from the banks or from other lenders. In terms of finance houses now, certainly when I was growing up, there's many more places that you can access funding from compared to what it would have been like 20 years ago. So those abilities to access funds is much greater. You've got the LEPs, you've got local authorities, you've got grants in different sectors here. So there's lots of things you can explore to look at grants. Normally it's things like matched funding. So if you do get a grant, which is competitive potentially, you've got to match that funding depending which part of the country you're in as well. So we have enterprise zones and economic areas in the UK. So your area in the UK may be one which could like a pseudo regeneration zone there. So there may be funding available at your local level, local authority that says, if you want to invest in this area, you want to buy equipment, we can fund that for you. You can do things like leasing. You can do a straightforward rental. All these things, by the way, have got different categories of risk, different elements of cost there. I wouldn't normally recommend somebody to actually go out and make an outright purchase of cash unless it's a small amount to buy an asset, because it's about the responsibility of looking after the item as well. So lots of different ways to fund it, but I wouldn't use it as a barrier, because I think lots of people stop themselves, and I think that's a bit of mindset as well, Jo, for making that big leap to say, I need to invest, because they're scared. They think of a cost, and mindset wise, I would actually flip the language and actually says, if you want to go in a particular direction, you have to invest. It's as simple as that.
I was quite interested in it's a while ago, and I heard Chris Evans talking about when he bought into Virgin Radio, I think it was, and he was asked about the risk because he invested tens of millions or something. I don't know the exact numbers, but he said, well, it's the same as any other number. It's just money and it's just a number, and you've got to see it like that in order to you've got to treat it seriously and with respect, but it's still just money and just a number like any other number, and is 40 million more or less likely to fail than 10,000, for instance. So I think you're right, that attitudinal thing towards risk and money mindset is quite something, isn't it?
That's a great point that you make there. I didn't know that story about Chris. That's an interesting one. I'm going to look that up later on. But I think that's the thing about, all of us as human beings, we've all got different risk appetites, different views of the world in terms of risk. And it's not saying you must go out there and be gung-ho and, it's only 40 million. Yeah. But if you are going to make a decision, if you've got a financial plan, you can do things like, what happens if it all goes wrong? What does that look like? And you can risk mitigate, you can reduce the risk. You can't guarantee it's not going to blow up in your face, by the way, but you can certainly do things to actually try and reduce the likelihood of it all going wrong.
Yeah. So as well as that, I think there are companies that, and I know they want to do this, and they've asked us for help in doing it, and we've been helping them on spring cleaning their financial reporting, the information they use to manage their business every month, the information they use with their board and non-executive directors and advisors and so on. So, what can people do to really get great financial reports, not just for steering the business, but also making sure they get the best value from other directors, non-executives, and people who are supporting them in different capacities? What's a great set of board reports or management leadership team reports look like?
Right, now, just like with all general statements, generally speaking, actually, I think the standard of reporting information internally on a month-by-month basis is quite poor in the UK and the rest of the world. I think far too many, let me talk about the negatives before I talk about the positives. Far too many businesses rely on the annual once-a-year exercise where the financial statements are done. Far too many people rely on, we can get what's called a conventional profit statement here, and it's quite tedious, and it doesn't really give you any insight there as well. So I think the first start point is to avoid being overloaded with data and information there as well. So the ideal report for me, whether it's reported monthly or quarterly, is to say you want one sheet of A4, maybe 2 sheets that it's got some visuals, it's got some nice charts that summarizes the key numbers there. Focus on what's important for your business. So if you're a retailer, things like how much profit your product groups are making, how quickly the stock turns over, is going to be really important numbers for you to report on. If you're a manufacturer, things like what the cost of production is, what the downtime is, the level of wastage and scrap will be an important metric for you to report on. If you happen to be a service business, let's say, for example, you're a training company, for example, you've got a fixed premise, then obviously bums on seats, occupancy is a key number to you. So blend up the key numbers with some non-financials, but You've got to ask yourself as a board, as a group of senior management, what's important to you to understand to help you make much better in your actual job and your responsibilities. And that is what you should be reporting on. Not what the finance team say you should be reporting on, but what's going to help you in your job role. And it will differ. And that's the key things that I would probably focus on.
Yeah. So where can people go, if they need some help with that in terms of getting that set up? Where are some good resources? I mean, I know you've got some amazing resources on your website, haven't you, on proactive resolutions?
Yeah. So there's a few places. So the first port of call I would be is for business owners to actually talk to their accounting team there as well, and have that discussion with them that says, because their accounting team may not be aware of it, and just say, look, this is what we do, this is what we need. So that's one source of you can go to. So speak to your current staff, speak to your current accounting team, and drive them to give you what you need. The second source, depending what you want, we've got some fantastic resources obviously on our own site. We can make them available, but I would look at things like, there are things like benchmarking clubs that you can look at. UKTI, depending if you're exporting.
What's that benchmarking club? Just say a bit about that, and then we'll.
I think I'll dig out the actual official name later on, Jo. But there are organisations that like what they call like benchmarking organisations here that talk about KPIs, that talk about benchmark data. I would certainly look in terms of the quality of the reporting, looking at things like sort of digital platforms that do that. So whether it's a Xero platform, Sift, or whatever, there are different platforms that do that. So that I would probably look at that first of all. First of all, talk to your current team, tell them what you want, and if you've got a digital platform, which is an absolute must for me these days, if your business isn't digitized for data capture, data collection, you're missing out a big trick there.
Yeah, and so what if somebody's not happy with their accountant? I know so many people who are with the accountant because they started off with them, it was all right at first. And then, really that the accountant's not giving them what they want anymore. So presumably, once they've spoken to the accountant and they're still not getting the service that they're after, how hard is it to change accountant? Is it a big job?
Well, the actual physical transition isn't that difficult, but I think it's a mindset thing. So my advice to all clients is to say, look, first of all, have a conversation with your accounting already and see if there's any change that can be made. If you feel there is, then great, because they know your business. If you feel it can be rectified, try and rectify the situation, relationship you've got at the moment. If you feel it's not going anywhere, you're feeling let down, then what I would probably do is to think about what is it you think you need in your business. And I would do a beauty parade. I've got a couple of articles I can share about how you should choose your accountant, but you need to interview them and have a conversation with them. It's a two-way conversation. The thing is, what is it you actually need? What do you think would make your life better? There are certain bog standard things that all accountants should be able to do anyway, like year-end accounts. And then what else is it you think you need during the course of the year? Obviously, you can check out references, testimonials. You can do like TripAdvisor type thing to see what's going on. And I would talk to probably 2 or 3, but have a list ready in advance so you can talk to each other. Obviously, money's going to come into the equation. Get your proposal, and then if you've got a preset criteria, then make your selection. The actual physical pressing the button and say, let's change the mechanics of it. In theory, all accountants up and down the UK, if they're any worth half their salt, are used to clients coming and going. It's churn. It happens, okay? So what happens is typically somebody says, I'd like to go with you. You've got some administration, and the actual switchover process should take about a few days at most, just for transferring information. But accountants are under an obligation to do that. So, I don't think not the actual mechanics of switching, it's the up there that actually takes that big decision.
Yeah.
Like switching banks, isn't it?
Yeah. So people think it's harder than it actually is in practice, because the mechanics are easy. It's just really about going through the process of finding the accountant that best works for you. So, yeah. So there's lots here on financial spring cleaning. So I'm just going to recap and just pause for what we've covered. We've covered money mindset. We've covered getting from a not so great financial place to a much better one. And if you're in a good place, we've talked about cash and what to do with that. We've talked about tax efficiency. We've talked about the benefits of VAT registration and when doing optionally isn't such a good idea. And we've talked as well about all of this now in terms of, accountancy support and financial reporting, using financial information and also information to share with advisors and non-executives and so on. So it's there's a lot, I'm just thinking if people are sitting down and thinking financially, April, new tax year, maybe new financial year, it's spring anyway, the economy is changing. I know so many businesses are going back and having a look at where they stand money-wise and what the trajectory looks like. So hopefully these are really good prompts for people and some good insights, fantastic insights from yourself to point them in the right direction and help with that. You mentioned UKTI as well. So sorry, I butted in. I didn't mean to, but I think there was something good coming about UKTI.
Yeah, so I think we've talked about this before. So if you're a company that's looking at exporting, obviously outside the UK, which is what exporting is typically about, then UKTI is an umbrella body, I believe sponsored by the government anyway, which actually helps businesses to actually develop external markets, give them support, access to intelligence and information here. So it's definitely worth exploring there because I think there's also funding behind them. So therefore, all that expertise and advice that you can get from how your website should look, translating into different languages, currency exchanges, all that sort of stuff. UKTI are a really good body. I've worked with them before. They're a great body. So I definitely would get a relationship going, the UKTI, if that's the thing that's, within your sort of horizon.
Yeah. And I suppose a final big question, financial, so life planning. So for the long term, for that, for the big things you want to be in life and do and experience, for exiting, maybe selling and exiting a business, building a business that you can sell, or retire from at some point and let somebody else run and take over. What about that? Getting your business to the point where you can either do one or the other. What do people need to start doing sooner rather than later to make that happen?
That's a great question. I think that there's 2 or 3 things that spring to mind immediately. First of all, you've got to have a business that's actually capable of being sold on. So if a business is very much based on you, it's not got any real value to a future buyer because you're not going to be around. So you've got to have things like good systems, good internal things. You've got to have things that you can sell that are largely repetitive. So you've got to focus on building up a business that's capable of being sold, because what a buyer is going to pay you for is not the bricks and mortar, okay, but they're going to give you something called goodwill. And it says, outside of you, what's the business worth? I can step into that business. I can start making good, healthy profits pretty quickly or at some point in the future. So processes, procedures, systems, all the unsexy stuff here is the thing that makes that a scalable business.
Yeah. So, and what about, is it better to focus on turnover or profit? So let's just assume you've got a scalable business, and you want to grow it and maybe sell it on. Is it better to focus on turnover or profit? And how is that? What's that magical thing about how businesses are valued? You hear them talk about it on Dragon's Den, and they go, that's much too optimistic as a valuation. What's going on there, and what are people using to value a business?
Okay. I think, first of all, on a personal point of view, turnover is a waste of time. It's what's called a vanity metric, because you can be generating £1 million a year, but if it's costing you £950,000 to generate that revenue, you've got a very small profit. I think I'd rather have a business that generates half that turnover, but actually delivers me the same level of profitability. So for me, in general terms, turnover is an easy number to identify. That's why we like it, but it's actually a pointless metric. It's about profitability, money in the bank. And the second thing I would say going on, that's a great question, Joe, about how do you value it? There's about 5 to 7 different ways to actually value a business, using formulae, computations, whatever, okay? But the reality goes is between there's a buyer, there's a seller, how desperately does one person want to exit, and how desperately does somebody want to buy you? So it could be because they see you as a part of their distribution channels, a way to get into a marketplace, maybe sometimes to shut you down. So whatever that motivation, the reality is, whatever you calculate will not be the number that somebody will give you. So if you look at mechanics, there's about 3, possibly 4 easy, straightforward ways. The start point is to say, if your business stopped tomorrow morning and you had a garage sale, a fire sale, what would you get for the bricks and mortar? So if you've got any inventory, if you've got any equipment, pay off your debts, what's left over. That is your minimum walkaway number. On top of it, then you're saying, okay, my business can generate profits for the next few years. If somebody took it over, how much profit would they generate? And you can come up with various multiples, X times the last year's profit, how you can do it on that aspect. You can do it on cash flows, which is probably a popular method. So how much cash does the business generate for the next 10, 15 years? Convert that to what that's worth today, and that's the value that you'll get. Depending how big your business is, by the way, most companies that are sold aren't PLCs. They're what I call non-quoted companies. So therefore, it's difficult to say, because there's no marketplace for your business here. So you might compare yourself to a retailer, might compare themselves to Morrison's, do a few computations adjustments and say Morrison shares are worth this much. There are other supermarkets out there, by the way, folks. So therefore, my business is not as the same league as Morrison's, but I can use that as a reference point there as well.
Yeah. Okay. Great stuff. So, and any other final tips for anyone who's doing a big financial spring clean and think through all the numbers this spring? What is there anything else I've missed that you'd add in? That you think
I would say two things. First of all, do it slowly. I think we talked about it when we picked up the innovation last week here. It's very easy for your head starts spinning and there's so much to do that you don't actually do anything because there is so much to do. So start off with the little easier things here. So the bare minimum I would do is to try and be efficient in your business and try and cut down the amount of laborious tasks. Invest, if you haven't already, invest in good data capture systems. Yeah, so accounting systems that basically do all the heavy lifting of capturing the financial transactions, so you can tell pretty much quickly how much profit you made last week, how much profit you made a month ago, without having to wait weeks and weeks. That's one thing. Do it slowly, but I would work on that first. So if you're somebody who's disconnected from your numbers, just have a look at your bank statements once a week. See what's going on there. Just read them like a story. See what's coming in and out. Try not to depress yourself with it, but I think you should start getting closer. So those are the two things I would start doing. And one thing above everything else, Joe, and I said at the risk of boring everyone, you must do a financial plan. If you don't do a financial plan, I think you're really taking a dangerous route in your business.
Yeah. So that message is coming through loud and clear that whatever you, and I agree with it, fully support it. So whatever you're doing in your business, create a financial plan and create the story of your business, and also look at your numbers and see what story they're saying about your business and what you can learn from it. So Mahmood, that is fantastic. There's so much value and knowledge and insight in all of that. So thank you so much. And we'll be back next week, won't we?
We certainly will. And I think we're going to talk about spring cleaning on a wrap-up function next week, I believe.
Yes, we are. So some more great stuff coming next week. We'd love to hear from you. What have you thought about the show? Is there anything in here that's resonated? We'd love to know about it. And also let us know if there are other topics related to this, connected or completely different, that we can help you with. That's what we are here for. And do head over to mahmoodandjo.com to sign up, because we've got some exciting things coming out in the future to share with you. Loads of free resources that you'll be able to get. So we're just working on that now as part of our spring clean, but they'll be there soon.
100%.
Yeah. Thank you, Mahmood. So shall we?
Folks, thank you very much. That was a fantastic question there from Joe. And until next week, have a brilliant week.